Hey guys, welcome and thanks for joining us. I am Vinny Carriers from WCG Investments, and I'm here with my partners Tim and Matthias. And we are really excited because we have a deal under contract in Northeast Alabama, just outside the Birmingham metro area. It's only like an hour away, not that far out. So we like to keep you guys in the loop. As soon as we go on the contract, we want to keep you guys in the loop to see what, to share what we're seeing and see if it's going to pan out, right? So this session is all about giving you the insight view of what we're seeing so far and why we like the deal. So, so high level, it's a 5-park portfolio, 283 lots. Again, it's just outside of Birmingham. All parks are within an hour. And I think at most 30 minutes. So, with that said, let's get to it. Tim, how did we find this deal? Quick overview, what caught your attention?
Yeah, so, we had seen this deal maybe a year ago, I think, and then made an offer, and then, it didn't pan out, and I'm pretty sure, maybe a few months ago, maybe 3 to 4 months ago, we brought on my wife Jen to kind of help out with acquisitions, and she was just going through old stuff in Podio, and transferring it to Go High Level, our new, software. And she saw this one and said, "What's up with this?" And I said, "I don't know." And so I think she reached out to the broker, and he said it's still available. We had some really good back and forth calls. Um, there's a lot of different iterations of the deal that could have happened, a lot of back and forth, but that's usually how it is. But yeah, so long story short, the deal was revived. The other people who had it under contract who beat us, uh, uh, to the best of my knowledge, were just kind of, uh, uh, you know, said that they wanted to buy it, but then we're putting a ton of obstacles in the way of actually getting a contract out. So, it's so easy. Like anyone can say anything. Oh, I'll pay you $100 million for this, but like that means nothing until you're actually pen to paper and closing it. So it was one of those things that our acquisitions follow-up game is really strong and has led us to get this one under contract.
That's awesome. So, Matthias, why Northeast Alabama? I know it's close to a good market, but what is it about that market that you like?
Yeah, when we looked at it the first time, Tim and I actually drove the market late last year, right? So at the time of this recording, it's end of February, and we looked at this, like Tim said, for a while, and then I think right before Christmas, we actually did a trip to the market and actually try to feel the market and check it out. Meaning, we talked to a lot of local residents, right? And we drove through the parks at day, at night, etc. And what really stood out to us was these parks are really, really close to like all the hustle and bustle in Oxford, right? Oxford has tremendous growth. From 2010 to 2020, actually grew over 46%. There's a lot of growth there. If you look at on the map where these mobile home parks are located, they're literally within 5 to 10 minutes of all the major retailers: Walmart, CVS, Walgreens, everything. It's actually right off the interstate there, within like 5 minutes of the exit of the interstate. So, and this interstate connects Atlanta and Birmingham. It's kind of like right in the middle between the two, which is pretty good. So, and when we drove through there, you can just tell like there was a lot of traffic. That means there's a lot of life there, a lot of people spending a lot of money, and there's growth there. So the industry is pretty strong as well. This is a 5-park portfolio, so it's not all in Oxford. It's also in Anniston and Jacksonville, and they're all within like a 25-30 minute radius. Anniston experienced some slight declines, but it's been very like stagnant for many years or decades really. And the other one is in Jacksonville, Alabama, not Florida, Jacksonville, Alabama. And that one is like a college town. It's one of the best looking parks out of those five, and this is also a rapidly growing market as well, which also seen some very tremendous growth over the last 10, 20 years, also over the 50% plus in the last 20 years. So there's definitely something to be said that the market has grown very rapidly. And what is really cool about Alabama markets, which I've always seen, is their lot rents are really, really low as they are right now. and especially this portfolio, we're lagging market rents pretty heavily, and there's a lot of potential. There's a lot of growth there, right? So a lot of rents, averaging like 350 to 400 in that market, and we are under 300 average on this portfolio right now. And then if you look at, like, we have 283 lots in total, there's tremendous revenue growth we have right there. So and I think that market itself is growing, and we could feel that when we were there. So there's a lot of potential there. They have a little bit of a tailwind. Also experience some rent growth because our area is growing so much. So I feel like there's a lot of cash flow coming our way, which can be used as a defense mechanism as well, of course. So it's a very cash flow heavy deal here.
That's awesome. We really like the cash flow heavy deals, especially when they cash flow day one. That's awesome. So just to give you guys a breakdown of the portfolio layout. So it has 89 tenant-owned homes, 53 parked-owned homes, 40 rent-to-own leases in place, 41 vacant park-owned homes, 49 vacant lots, so there's room for infill, and it comes with 11 single-family homes. Okay, so in terms of utilities, all parks have public water access. They're directly billed to tenants or billed back. In terms of sewers, 2 parks have public, 2 parks have septics, and 1 park has partial public, partial septic. City electric on all 5 parks and directly billed to tenants. So from that end, we're looking pretty good. Let's talk about financials and upside. Matthias, what is the current income profile, and where do you see opportunities for improvement here?
Yeah, good question. So income-wise, what we really like about this deal, since it's so cash flow heavy, we buying this at a 10 cap, which in layman's terms, that means if you if you buy a property all cash, you get a 10% return on it. It's actually 10.5 to be precise. So which is huge. All 3 of us been just at a conference where there's a lot of multifamily investors and operators there, and they don't buy anything at a 10 cap. And I mean, the loan on this thing as well is in the mid to high 6s, right? So we have like a really strong 3.25% spread between the debt and the cap rate, which is huge. And in multifamily apartments, I like to pick on those, they're collided at break even these days. So that means there's no cash flow. But this one has so much cash flow, which is amazing. So right out of the gate, in financials right now, they have a $1.2 million of income coming in right now, and that's below market rents, and with a good bit of vacancy as well. So financially, I see a lot of potential there with the vacant homes and also the vacant lots, where we can even increase that significantly.
Tim, how does this deal fit into our overall return targets?
Yeah, we don't break the mold. We, have figured out what we're really good at, and then just do that over and over and over again. And so, every deal we look at, we're looking at a 2x equity multiple in 5 years, a little bit more in 7 years, depending on the deal. So we're, exiting in 5 to 7. Our IRRs generally, 16 to 22%, depending on the deal. This one fits in on that. And what's even cooler is, the more we do this, no, we're not breaking the mold, but we're looking for bigger. And bigger deals translates to safer deals. Because, if you have a 10-unit mobile home park and one person doesn't pay, you're at 90% and you're losing sleep. If you're at 250 plus units and one person doesn't pay, that's like, it's not noticeable. It's something that we've already put into the deal, like we're expecting it, because it happens, right? So the bigger projects that we're doing, the safer it is for our investors, our partners, ourselves. The less worry we have about the deal. So yeah, the more we do this, the more we're looking at, like, how can we continue to protect investments? How do we put safety of capital first? And that's what we found. The bigger makes it a lot safer than smaller.
Absolutely. You touched a little bit on risk mitigation, but Matthias, what are the key risks with this deal? and how are we planning on mitigating?
The key risk really is we have to be careful how we infill the vacant lots that we have. So we never really go in and say, okay, there's 50 vacant lots and we're going to fill them all for multiple reasons. It's just exit optionality as well. If you would ever like to exit, there needs to be some meat on the bone so a buyer can come in and actually see a value add on their end, right? So you open up the buyer pool in that way. But also operationally, it puts less stress on operations in general to get the homes infill. Because infill is a tedious process. Buying the home is the easy part, but actually getting it all set up and then rented out or even sold is a different story. So with these here is we don't expect to sell these homes cash because it's not a small market, but it's a market where there's more renters, as a more renter market basically. So it fits the mold of perfectly of like long-term rent to own, where we don't have to be responsible for repair and maintenance costs, but also we not if we can sell them cash, we will. But what I can see from a market perspective with the medium income in the area and medium home prices, it will be perfect for like a long-term rent to own kind of thing, which then of course fuels the cash flow, right? Because you get this long-term cash flow, not just like that big lump sum of cash where we sell these homes, almost like flipping them. We planning to really put in 21 out of 50 vacant lots, like 21 homes out of the 50 that we could put in, which is less than half. So that's really strong risk mitigation there. Because typically, we try to overachieve there and under promise. So we might land at 25 to 30, but it's just the first year no infill on paper, but we're gonna start the infill in year one, so we get a head start in year 2, 3, and 4, etc. And it's basically like 4 years starting in year 2, but we can easily do 2 per quarter, for example, that we usually do, which is a pretty good cadence. Getting 2 in, getting leased up, because there's a debt service attached to these homes, so we finance them. And then when the next round is ready from the manufacturer, we have the first 2 leased up and get the next 2 in every couple months. So that's what we're looking at there. And that cash flow that we're getting in is like a good first line of defense. It's a really heavy cash flow deal. So debt service coverage ratio is insane. It's really strong. The cash out of the gate is really strong. I love it on this deal. So they actually pays preferred returns really solidly out of the gate in year one. Really good there. Um, You're also investing a lot in like cleanup of the parks. So there's some parks that actually have tremendous, quality, right? There's almost nothing you have to do. And there's some parks where there's a lot of tenant-owned homes where we would go in and say, hey, we're gonna offer you guys the clean up, pressure wash the siding, and even paint it so it looks like a nice park. And it actually makes new homes fit better into the community and also makes it easy to find residents that want to buy these homes over long-term rent to own because you attract a better tenant base that way. So it's a little bit very nuanced risk mitigation because we want to make it a better place to live, and then have basically a better looking park with a better curb appeal, which attracts better tenants, helps the financials, and that make sure we pay debt service and also our investors back. So yeah, this is the main thing. On the vacant park on homes, of course, there's always something that can go wrong there. But we have a pretty juicy budget defined for those to get these turned over, which is at like $10,000 a home on average. Which many of those homes we probably don't have to spend that much. Some of these homes we're probably just going to demo if needed, for example, and put a new home in, so we can kind of use some of the proceeds, 5,000 for demo, and use the other 5,000 for down payment for a new one. So it kind of works out. Be very dynamic that way, and you stay nimble as you go through things. And the last point on like the infill, we also have the infill very targeted because this is a portfolio in Calhoun County, and there is out of these 5 parks, there's like one park which is majority tenant on homes and has a couple vacant lots. But that park is a little bit out there by itself. It's a very stagnant market, but a very small market within that portfolio. But it's like 25 minutes away from Oxford, where it's really buzzing in that market. But you want to have that tailwind and actually placing these new homes in that buzzing market. So we have very targeted infill as well. So we mainly focusing on Jacksonville and Oxford, where like there is the major growth epicenter in that area in Northeast Alabama, and we're going to put these homes there. So that's very targeted infill, which reduces a lot of risk.
That's really good. Sounds really promising. Tim, can you share with our listeners how resilient is this investment in a downturn?
Well, I mean, it's like I was saying earlier, it's more resilient because there's more units. Um, so if there's a downturn, and people have to uh, you know, room up with someone, right? So it's like you can't afford your rent. Um, then, I mean, likely with mobile home parks, they're going to be, yeah, like having people move in or moving in with each other in this like affordable housing instead of just, I mean, moving away. It's always something we're cognizant of. If there is a downturn, what can we do? Do we need to adjust rents and all that stuff? Um, but overall, whenever there's a downturn, we're usually, the most recession resistant. So obviously nothing's guaranteed. Who knows? But it is something that we definitely pay attention to and keep our ears to the ground and what I like about us is that we are small enough of a firm that we can pivot when needed to ensure, the maximum health for any park at any time. I think uh, these parks are going to be incredibly resilient, especially, I mean, there's, multiple employers all around. There's places where people work and, there's all sorts of things that enable these parks to be better suited for any kind of downturn than a lot of other real estate. So yeah, as usual, I'm bullish on mobile home parks. I think the need for affordable housing is always there, and I'm confident that we are able to provide that affordable housing to people better than anyone else can.
Absolutely. So, how does this park fit into our existing portfolio, Tim?
So I like that question because it's in the southeast, and that's what we're buying. So we don't own in Alabama yet, but it fits really well into kind of our path of progress, if you will. We own in Virginia, the Carolinas, Georgia, right now. So I'm excited to add Alabama to what we own or where we own, and we really love the southeast for all the ability for us. They're very landlord fair. I know a lot of people say landlord friendly, but it's more like it's fair. If you don't pay, you gotta get evicted. Like there's not a big question about it. So yeah, it's just expanding our reach to the southeast. Again, we don't do anything that is like breaking the mold. We do what we do, and we do it really well, and we just keep doing it. Um, so yeah, I'm excited about this one.
Matthias, if you had to summarize in one sentence why you like this deal, what would that be?
Cash flow, baby. I mean, you can't beat cash flow. That's my take, man. I mean, cash flow solves a lot of problems, pays investors, make sure debt service is paid. I mean, that's really really good. I mean, apartment people they don't have these cash flow nowadays, and they have to accrue preferred returns and pay them back later, and betting on appreciation based on like forced appreciation by improving NOI and stuff over time, which we do here too. But you have that cash flow in the meantime, which puts food on the table before we can refi or whatever sell after 5 to 7 years. So that's huge. I think cash flow really is the big one here. What I'm excited about.
What about you, Tim?
Okay, you guys remember when we were just at the best ever conference and some like apartment people, someone was presenting on stage. They said if they could get like a 1 percentage point spread between their interest rate and the cap rate, then they're like doing better than most right now for apartment buildings. Um, so with us, we are looking at, a 3.5 to 4 point spread. Seeing as, it's like a 10.4 cap and our debt is like 6.7, 6.8 projected right now. And I mean, these are actual numbers that we've talked to, banks about. So we're not just making stuff up. Like, I love mobile home parks because they cash flow so well. Anyway, so my favorite part about this, my one word for this deal is safety, because there's safety of the investment. Again, I keep talking about how bigger is better and bigger is safer, and it's so true. In the 25 parks we have, the ones that seem to do the best are the bigger ones, generally, right? And there's just so much built-in resistance. If any downturn, anything happens, we have a lot more safety with bigger deals generally.
Cool. Some closing remarks. Matthias, final thoughts on why now is a good time to start looking at that Birmingham market.
Yeah, this location is great. I like the growth between Oxford and also Jacksonville. I mean, they grew over 50% in the last 20 years, which is amazing. If you look at on the map where the employers are, I mean, Honda Manufacturing Company is there as well. They have 4,500 people, 20 minutes outside of Oxford. If you look at where the parks are located, they're right off the interstate of I-20. So you literally, if somebody is working at Honda, they can literally just go on the interstate right there and take one exit, and it's like 2 minutes from the exit is the mobile home park. So, and that's typically the people that work in manufacturing, assembly lines. They're the tenant base that we are employing, like blue collar people, hardworking people, and I like to see that on the map, like a growing market. Right, with a lot of potential. It's not like super saturated yet, because it's not Birmingham, it's not Atlanta, but it's in between, and it's a growing market. It's a very strong secondary market, and I love those big manufacturers out there because they do the hard work for us. I'm come from automotive, and I work with Honda, and it's one of the best manufacturers out there. They know what they're doing, and they're putting their facility there for a reason. Look at how big the United States are, and they decided to go into that market in that area and build a major manufacturing facility. This is huge in my book. And they spend millions on marketing. They know what they're doing.
Matthias, Tim, last minute comments?
Go ahead. I don't know. Same thing I've been saying. I'm excited about this deal. Again, we keep doing the same thing over and over and over and over again, and we keep getting better at it. And that really allows us and allows me to say no to so many things, like right off the bat. And when we find something that checks all the boxes for something that we really want to go after, and then we get it under contract, I'm excited for us. I'm excited for our investors. I'm excited for the tenants, just creating that win-win-win across the board.
All right, guys. As you can see, this is still preliminary. We just went on the contract, but the fundamentals are strong, right? We like the market. The parks offer both stability and room for upside, and the financials align with the returns we target for our investors. Our due diligence period is going to start now, so we'll keep sharing updates as we move forward through DD. Something worth noting is that once the offering goes live, it will be for 506C accredited investors only, so keep that in mind. If you'd like to learn more or stay in the loop as a deal progresses, see the link below and you can be added to our investor list. And if you know someone who would be interested in opportunities like this one, please feel free to share this video with them. So with that said, thanks again for joining and have a great day. We'll be in touch. Bye.